Hello and welcome. You're watching Money 9. I'm Sakshi Batra, and on this show, we are going to be discussing about the rising case of inflation. But before I go ahead and introduce my guest to you, I have to request all our viewers who are watching us on YouTube to like and subscribe to our channel and also hit that bell icon so that you can get notified whenever we put out a new video. Also, you can stay connected with us through all our social media platforms, that's Twitter, Facebook, LinkedIn, and Instagram, where we put regular updates on markets, business, personal finance, all of the news that's of use to you. And also, you can go ahead and log on to money9.com on our website, where you'll get to see the latest headlines and the news stories both in English and in Hindi. Let's now welcome our guest for the day. Karan Bhasin joins in, policy researcher and economist on Money 9 News with us. Thank you very much, Mr. Bhasin. It's a pleasure to have you back with us on Money 9 News, and it's always a pleasure speaking to you about these insightful topics on economy and on markets, all those things that are of concern to us and all our viewers right now, especially with regards to the inflation figures that we've just got yesterday with respect to WPI inflation rising, hitting an all-time high of 12.9%, retail inflation jumping above the RBI's comfort level of over 6% at 6.3%. This is a 6-month high as well. Also, when you talk about the core inflation, that is also quite sticky at the moment at around 6.6%. And there are a whole lot of concerns that are being raised as to what will the RBI do now and what does it mean on the rates this time around. All of those things is what something that I want to discuss with you. First up, help us understand, and all our viewers, what are the key reasons you believe are behind this surge in inflation at record highs?
Yeah, thanks for having me, Sakshi. Always a pleasure to talk to you. A lot of people are aware that I've been at the issue of inflation, not just in India, but across the world over the
Yeah.
last 6, 8 months. And it has occupied a major part of my research, which is jointly with Dr. Surjit Bhalla and Dr. Prakash Lungani at the IMF. And when I'm speaking right now, I'm just talking on my personal in my personal views on this particular subject. So they may
Hmm.
not necessarily agree with everything that I say, but this is just to say that we have been looking at inflation quite closely over a very long period of time, over 30 years, and
Hmm.
what we find is that over the last 30 years, consistently inflation has moderated across the world, and that has been the norm, except for a
Hmm.
certain deviations every now and then. And the reason I'm
Hmm.
saying this is because when we are looking at these numbers, we need to put things in context, because the present numbers are for 2 months, 3 months tops. Especially when we talk about WPI. Uh, and the reason I say that they're for 2 months top is because last 2 months WPI was high, and the reason why they are high is because previous months of previous year, the same months, WPI was negative. So the correct way to look at WPI is that last year when there was lockdown, there was no demand for commodities, and commodity prices, kind of started falling. We all know about oil prices, which actually turned negative
Hmm.
last year in certain spot exchanges. Now, when you
Hmm.
have a decrease in oil prices, or decrease in commodities, the very next year you do expect, as economic activity recovers, that the demand for those commodities will actually move up closer to the pre-pandemic levels, and
Hmm.
that will again result in prices increasing to that
Okay.
particular level. And that is exactly what we see, which is happening in WPI. For instance, WPI June 2020 to May 2021, the inflation is actually 3.66%. Now, when I look at the same period, which is June 2019 to May 2020, the WPI was 0.77 for India. And the reason
Hmm.
it's low is because, obviously, because of lockdown, pandemic, etc. So let's go to one year before the pandemic, which is June 2018 to May 2019.
Yeah.
WPI in that year was 4.09. So when we compare to the pre-pandemic levels, the rate of change, the inflation in WPI is not significantly higher as many are making it out to be. So my sense is that what has happened is that because of economies picking up, there's a surge in demand, and supply takes time to adjust.
Hmm.
And that adjustment is underway, which means that from September to August, September onwards, we should see a moderation in the commodity prices, in WPI prices, to some extent, at least for certain commodities, which will ease the pricing pressures on the WPI. Now the other issue is of what's happening to the CPI, because
Yeah.
WPI is more concerning for firms, for businesses, etc. But CPI is what affects the Aam Aadmi, people like you and
Yes.
me.
Yes.
And CPI has been higher throughout the last year.
Hmm.
And it fell till about May. May it was around 4.3%, roughly around that level,
Hmm.
and I think that's still within the manageable limits, and RBI would be pleased to have it there. May
Hmm.
figures are beyond 6%. They're at 6.3. From I mean,
Yeah.
broadly at
Yeah.
6.3. Yeah, so they're slightly off towards the uh, comfort zone of RBI. But here's
Right.
where it gets quite interesting. Inflation seems to be picking up across the world. And the reason it's picking up across the world is because we had a very big supply shock. And that supply shock disrupted production of goods and services. And now, as you alleviate those pressures and people start getting back to work, they start demanding as markets start opening, supply isn't able to catch up in such a short span of time. What people are
Hmm.
forgetting is that there was a simultaneous and larger demand shock because a lot of
Hmm.
our wages got slashed. So the
Hmm.
demand will not, adjust instantaneously, which means that once you lose this momentum which you're getting after opening up of the economies, pricing pressures would begin to ease out.
Okay,
Which
these are
again,
very
yeah,
important points, and
yeah.
we have to discuss each of them individually as well. Together. Let us break it down for all our viewers. One, you said that of course there is an effect of low base, which is why we are seeing the WPI inflation at a higher level, and which is why it is appearing to us much higher. Second of all, you're saying that the supply constraints have actually led to this kind of a jump up in the prices. But I want to understand for lay people like you, me, and people around us, our viewers. When we are going outside in the market to buy things, there are prices which are high when we buy edible oils, when we buy vegetables, fruits. You talk about everything, fuel prices, 100 rupees for petrol, over 100 rupees for diesel also, which again has an impact on the vegetable prices. Because so how do you address this concern then?
So the aggregate CFPI, which is consumer food price inflation, was at 5%,
Hmm.
which again is comfortable. I mean, I don't see that as a major problem. But what you said about edible oils, that is a problem because edible oils, had I think 30% or so inflation. It's in double digits for sure.
Hmm.
And the other issue is, of course, eggs, meat, high protein pulses. There is inflation that is something that has to be addressed. And I think
Hmm.
supply side interventions by respective governments will ensure that those price pressures are going to be eased out. Also, we need to
Hmm.
remember that there are seasonal factors. It goes up sometimes, it comes down. So a lot of those factors are also at play. More so for edible oil because we do import a lot. So if there is a
Hmm.
disruption or change in weather conditions in some of the edible oil exporting countries from where we primarily procure, we will see
Yes.
some increase in prices. And I also think that the weights in CPI of edible oil are lower because these are 2011 weights. So they do not reflect the consumption basket that we have
Hmm.
in the particular year. So there is that issue as well, which has to be captured in. And I'm sensitive to the fact that prices are going up. Inflation
Yeah.
doesn't mean, I mean, low inflation doesn't mean that prices will not go up. Inflation actually
Hmm.
measures the rate of change of
Hmm.
prices. It measures the increase in prices.
Hmm.
But vegetables and cereals, the inflation was actually down. It was negative. So prices have
Hmm.
fallen because of
Hmm.
excessive production. I think we're going to
Hmm.
have a fairly good monsoon, which will further ease out price pressures for a lot of pulses and a lot of vegetables, fruits,
Right.
etc. For meat and eggs, again, I would say that a lot of it is because of the lockdown and those restrictions, which are creating disruptions in different markets. But the
Hmm.
issue of oil is an important one, and we have discussed it in the past.
Yes.
And I do think that there is scope to do something there because the tax component is high.
Yeah. And
But
the
on
RBI has
oil,
also urged the government to cut the excise fuel now, excise duty on fuel, as the prices
yeah,
have touched over 100. Yeah.
Absolutely, because it may not impact inflation directly. The indirect impact may not be as big as it used to be earlier. But
Hmm.
the reason why I think we need to do that is to bring down logistics cost, which is consistent with our vision of trying to attract supply chain.
Hmm.
So my argument is not so much from an inflation angle, but more
Okay.
from a competitive, angle. That if we want competitive supply chains in the country, and if we want to be a part of a global supply chain, then we
Hmm.
really need to figure out what is the most appropriate mechanism to tax
Right.
petrol and diesel. I had argued for increasing taxes in last year when the lockdown was introduced, because it was a convenient mechanism for raising revenue. But back then, revenues from other sources weren't there. GST revenues were low, direct tax collections were going to take a hit. This year, a lot of those pressures aren't there, which means that it is possible to go back and cut both excise and VAT. So I think an appropriate discussion needs to be held on this issue between center and state governments, and both need to figure out a mechanism to reduce oil prices, not so much for curbing inflation, because the impact on inflation may not be as significant as it used to be earlier, but more so from, largely from the angle of competitiveness of our companies.
Right. A few more important things that I have to discuss with you. One, with the respect of the RBI, I want to understand one more thing. Like, you did say that supply disruptions are causing this kind of an aberration in the prices, the rise in prices. We have seen that the central banks around the world have infused a lot of money uh, by way of liquidity, so that there is support in the kind of growth recovery that we are seeing. Is that also a cause behind this rising inflation? If that is, will there be a change in the RBI's stance on liquidity? Do you believe that? And because now CPI inflation is on the upper end, beyond the comfort level of the RBI, what happens to the interest rates? Most of the viewers will be wanting to know that. Will there be a change there? Will this actually force the RBI to look back from the growth priority to inflation priority now?
You've asked a question which probably a lot of economists are trying to address right now. And actually, it's a three-part question, the way I look at it.
Yeah,
First is that,
yeah,
the money supply inflation trade-off. I personally don't believe that it exists. I think
no.
uh, money supply leads to asset inflation more so than real inflation. I think there are a lot of other factors that determine inflation levels, which incidentally is also a part of the inflation project, which I think should be done in a couple of weeks from now. So I think I'll have an interesting set of results on it. But yeah, I mean, the evidence that money supply or fiscal deficits have significant impact on inflation is not really as robust as it would appear to be, because there are sizable other structural factors that play a more important role. For instance, in the case of India, I believe MSPs play a lot of role in terms of determining inflation, because food is a major component of the basket. So for every 10% increase in MSP, your CPI goes up by like roughly 1.8%. Right.
Sure,
So
sure.
that's the main driver. And for some reason, MSPs have increased. There have been very modest increases, like 3% or so, but
Hmm.
there has been an increase over there. Right. And I
Hmm.
think a lot of it also relates to the political economy question of farm laws,
Yeah.
and which is a separate issue. But so MSPs having an impact is of course one thing that we need to keep in mind as another alternative explanation rather than money supply. My sense is that
Okay.
globally central bankers are also not uh, going by the conventional argument that excessive money supply is going to lead to inflation. Inflation, as I
Hmm.
said, for the last 30 decades, we haven't seen it. I mean, not in India. I mean, in India, we did see it, but across the
Hmm.
world, we didn't really see it.
Hmm.
And because we didn't really see it, despite massive amounts of quantitative easing by ECB, by the US Fed, I think there is a sense of belief that this is a temporary inflationary impulse, which is created because of the supply shock. You let the economy restore, and you let the economy recover completely, and then
Hmm.
you think about doing undoing some of the policy support that you have already provided. And
Hmm.
I think RBI is also going to do the exact same thing. I don't think RBI is going to go out of its way and increase rates. Keep in mind the
Okay.
third point. The third question is that why would you want to increase rates when there's a lot of debt leverage which has been built into balance sheets which are already stressed? That's like going back into 2018 and doing those two rate hikes, which actually crippled growth and led to the collapse of two big NBFCs in the country. And I mean, the biggest lesson over here is that do not hurry in terms of pulling back policy support, because you really are dealing with information which comes with a lot of lag, and you cannot rely on just a couple of quarters for ahead forecast and the current data of 1 quarter to be able to undoing the policy. And given what we have seen by the RBI, it has shifted focus towards restoring growth, because if you don't restore growth, then eventually you do tend to damage your long-term growth prospects significantly. and
Absolutely.
and and I mean, everyone is stressed. Government is stressed, households are stressed, corporates are stressed, right? Everyone is borrowing or raising debt in some form or the other.
Right.
And government will take a hit if there's a rate hike, which will limit its ability to spend and help us get out of this crisis, which is why I don't think that's going to happen. Corporate
Hmm.
sector is going to be adversely affected because their debt servicing costs are going to go up.
Hmm.
So yeah, so as I said, I just don't see RBI increasing rates at this point. If they do, I would be very surprised, disappointed. But then again, RBI has disappointed me quite a lot of times between
Hmm.
2016 and 18. So.
Okay, okay. So liquidity out of the day, that's not really causing the inflation. It is the supply shocks. What is adding to the trouble? Would you say that the rise in oil prices is one clear issue because of which we are seeing this rise in inflation? And what do you say to the argument of experts who say that, perhaps this inflation is going to remain persistent because oil prices are on a high, they are going to go up, and this is going to be passed on in terms of fuel prices. We are already seeing raw material prices also will be passed on. Manufactured products, we already are seeing a hike there. So some experts are saying that it is going to be persistent and 6% plus is going to be there. I mean, like, what do you have to say to that?
So again, three questions that you have asked. First on the issue of oil prices having an impact on inflation. My sense is that even if you reduce the duties, which I think should be done, no questions about it, uh,
Right.
the only difference it will make is that it will bring inflation back to the tolerable zone, which is like between 2 to 6. Now, whether it
Hmm.
is closer to 6 or closer to 5, that's an empirical question. But it doesn't really matter much whether it's at 5 or at 6, right?
Hmm.
So we need to recognize that oil prices impact has reduced. So oil shocks matter less because our economy and our consumption basket is a lot more diversified. It does feed into cost components, which eats into margins, and that has an impact.
Hmm.
But then again, I think it's a one-time adjustment in price levels,
Hmm.
and once that adjustment happens, you will see moderation in inflation rates, and eventually, when incomes go up in real terms, you will be
Yeah.
better off 3 years from today rather than being worse off because of high inflation. So I don't see persistent inflationary pressures. On the issue of oil prices, I have this theory, and I don't know, because I mean it's speculative at its best. So I wouldn't say that I've tested it out, but uh, you see, the reason why I think oil prices may not be able to sustain at that high level is because they
Hmm.
do foresee a lot of competition from renewable energy. Oil prices could have been at high and elevated levels earlier because there was really no competition. You need it for your energy needs. Now that's not so much the case, right? I mean, like if oil prices go, say, towards $120 a barrel, you will see a lot of people shifting towards electric vehicles. Governments are
Hmm.
actively encouraging people to shift, in which case the demand is going to go down. Uh, so 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 I would argue that oil price in on an average in a long term scenario would be anywhere between like $50 to $70 maybe, uh, and I think that's where it will probably settle once uh, things are restored. I am not surprised that oil prices are high because as I said, that there is a lot of pent up demand which is getting
Yeah.
released into the system. Let's take the example of US and housing prices, which is going through the roof because lumber is picking up, right? And this is an example for US, but it has a lot of implications for India as well, because
Okay.
lumber prices are going up over there, but there are duties that prevent them from getting it elsewhere. If they reduce
Yeah.
duties, there will be more supply and eventually price pressures will ease out. So
Hmm. Hmm.
your trade policy also plays a role in determining the kind of components which feed into the inflationary process. So that's another instrument which is outside the purview of RBI, which can be used by the government.
Okay.
Should food inflation persist, you can import certain commodities to ease out those pressures. I would not advocate for it, but yeah, I mean, like we do tend to do that a lot. We restrict export of onions, import pulses when prices go up, and
Yes.
and do all sorts of interventions.
Hmm. Now, you have said that you do not expect the inflationary pressures to be persistent, but I have to ask you one more thing, which is the gap that we are seeing between the WPI inflation and the CPI inflation right now. Even with a lag, the WPI inflation will also have some impact sometime on the CPI inflation. Is that a risk? Is that a concern right now? Are we going to see even worse numbers from here on? Because everybody would want to know that.
Well, WPI does, have an impact. I wouldn't say that it doesn't, but we need to see that it's coming from a very low base. So if you take the 2-year average change, it's 4%. In which case, it's not really off the mark. So it's not
Hmm.
really worrying in that sense. Reason why WPI is coming out to be higher is because WPI was quite modest. Last year it fell, and then eventually it was quite moderate throughout the year, less than 2%
Hmm.
for most
Hmm.
part. And I think that's why the price increase is quite solid in terms of the absolute levels, but eventually it's, as I said, not as much as many are looking and speculating on it. The other point I want to make is that a lot of people look at inflation and they think that it is a process, but what really drives persistent inflation pertains to wages. So the question is that whether inflation leads to nominal wages going up or whether
Hmm.
nominal wages going up leads to inflation. What we
Hmm.
do know at the moment is that nominal wages are down. Wages
Yeah.
have been slashed, at least in India,
Yes.
for
Yes.
and so when wages are lower, there's no demand side pull pressures on inflation, at least for a major
Hmm.
component of the domestic, demand. So
But then,
those
is there a
pressures
risk
are not
also
there.
for the demand to get further hit? We are already seeing weak demand at this point in time, and on top of that, when we see this high prices at the moment, is that going to be another risk that everybody has to face? Because again, it's going to be an added blow. First, the pandemic, increased healthcare expenses, reduced salaries, just like how you pointed out, weak demand. But then another, we are back to like a cycle where we are not
Yeah.
moving forward, perhaps.
This is exactly the reason why people are facing the pinch of 6-7% inflation. Remember,
Yeah.
inflation in the past was 10, 11, 12%, and that's when we felt a pinch. But 6% was normal. I mean, 5 to 6% was quite acceptable levels of inflation in India historically. But the reason why we are facing that pinch, or people are facing that pinch, is because nominal wages are down, so they see their purchasing power get eroded. But the question that you asked is quite important, and it pertains to the adjustment in the economy. You see, demand will eventually pick up. Demand will pick up when employment starts coming back into the system, when wages start beginning to move up, when labor market tightens. That will take about 3 months or so. To be very
Okay.
honest, it will take, and that is without another wave of infections, which I hope
Sure.
there isn't.
They
Uh,
don't. Mm.
yeah. So if it is going to restore over 3 months, by that time you will see a lot of excess demand in the global system largely address the flow component of commodities, because some commodities have two components: the stock which is available, which you can mine, which is the total availability of supply, and the flow, which is what you extract in any given year and supply to the market. So the flow component will also adjust, and that adjustment will take about a month and a half's time. So when you have that adjustment happening, and the demand sort of normalizing in that part of the world,
Hmm.
and because you're kind of 3 months behind the growth recovery process, so you do have a comfortable situation where you can uh, have demand coming back into the system without persistent inflation pressures. Even if demand comes back into the system, it certainly wouldn't be as significant as it would have been if we would have grown from 2019 levels for 2 years, right? So
Yeah.
that's the
Yeah.
opportunity cost which we also have
Hmm.
to factor in.
Hmm.
But
Hmm.
supply has kind of kept up. Overcapacities are built into the system.
Right. So, Abhilek, of course, very, very important points made by you here. You are trying to calm down all the nerves that there are, around inflation. But last word from you for all of us who basically just look at numbers and, we get freaked out. 12.9%, what does it mean for me? Is it a big concern? Is it going to be just an aberration, going to cool off soon? And I should not worry. What is the last message that you'd like to give before we wind up? I think you've gone on mute, Karan. No, we can't hear you. I think now you're on mute. Could you say something now?
Can you hear me now?
Yes.
Yes, perfect, perfect. So no, so I was saying that surely prices have gone up, but for people, what really matters at the end of the day is where they stand towards the end of the year, right? So if in the towards the end of your year, you spend a lot of money in 2 months, but your average monthly expenditure remains more or less the same. So it's not as bad in terms of your annual expenditure to meet your consumption basket. So if indeed inflation does moderate, situation may not be as bad towards the end of the month, but we will
Hmm.
have to face, this pinch at least for another month or two. It's just the way it is. I mean, it's a pandemic. Supply disruptions are there. We need to wait for supply chains to restore before we can ensure that price level, inflation is kind of at a muted level. So my only sense is that there's not much that can be done on this. Not on the government side, not on the household sides. It is a situation. It is the card that we have been dealt with, and we have to figure out a way to uh, deal with it. But having said that, on petrol, absolutely, I agree. That is one place where there is some scope. May not be a big relief, but there is scope. So even if it affects slightly, I think it's worth considering. So states and central government need to have an honest conversation on uh, petrol prices and how to go about them going forward.
Absolutely. On that note, thank you very much, Karan, for speaking to us and sharing your insights on inflation. You have calmed down the nerves on this record high level that we have seen on the WPI inflation. But the good part is that you believe there is going to be just a near-term pain, 1 or 2 months to go before it actually moderates further. For the central bank, you do not believe that the RBI will completely reverse policy or start rising rates. So that's another thing that has been important for us to consider. More importantly, right now, the major cause that we have been talking about, fuel prices rise, causing the inflation this time around, apart from the supply shocks that you've said, there is serious need for the central and the state governments to really think together and think of taking steps, reduce the taxes to bring down these fuel prices so that the pinch on the wallets of the common man is definitely reduced at that point in time, because there's not much, like you said, that we can do or much we have as policy tools to reduce the inflation that we are facing at this point in time. We wrap it up at that. Thank you very much for speaking to us. A pleasure as always seeking insights from you. And with that, we wrap up this edition. Many, many thanks to all the viewers to also for watching us. And do like and subscribe to our YouTube channel. Hit that bell icon so that you can get notified when we put out our new videos. Stay connected with us through social media platforms, Twitter, Facebook, LinkedIn, Instagram. We are all over, and we'll keep you giving you all the latest updates on markets and on personal finance space, help you understand what the economics really is going around, what are the news headlines that are making, and what is the impact of those on your wallets too. Many thanks for joining us.